Welcome back. And today I have a super special guest for you. His name is Jason Brown, and he's a founder and owner of Foresight Financial CPAs, an amazing blockbuster accounting firm providing tax advice, accounting services, bookkeeping services, absolutely everything need to know about finances for your company. Welcome, Jason.
Thank you so much for having me, Anna.
Thank you for being here. I know it's in the middle of tax season for you, so I'm going to keep it short and release you back to your clients. So let's talk about small business owners. Many small
Okay.
business owners think a CFO or Chief Financial Officer only belongs in big companies like Fortune 500. Why do so many small entrepreneurs wait until financial chaos hits before bringing someone like you on board?
I think a lot of it has to do with either a client or our business owner not necessarily wanting to pay for those services, or it could potentially be that they don't think they need it right now. They think they may have it under control, or maybe they don't really understand the value of what a CFO brings to the table. So I think that's probably the main reason. Sometimes when a company is really in an early stage, they're being very budget conscious, so they may not think they need it right now and they think they have a good handle on it. And then what happens is either they realize their margins are shrinking or their cash flow is having an issue, and that's when then we start to hear from them. So usually they don't bring us in until there's a problem. So, but generally, I think that's why.
I know when clients bring you on or start conversations with you, you offer what's called company wellness checks. If you look at, 10 small businesses with 1 to 5 million in revenue, how many would have financials strong enough to support real growth?
I mean, it's not, I don't know if I would give you like an exact number, but it's probably a lower percentage, maybe like a quarter, because um basically, companies revenues is your top line, and bottom line is really, is what you bring home. So that's really what matters. I mean, you can have companies that are making 1 million of top line and 500,000 of bottom line, or you can have companies that are making, say, like 5 million of top line and they're operating in a loss position. So as far as real growth goes, it's a function of having adequate capital, either from earnings, loans, or an equity infusion, and knowing how to properly allocate those proceeds and making sure that you're still looking at your gross profit and other KPIs. So, I mean, really, like I said, it's most companies may have revenue but not have great margins. And sometimes over time, as you grow, your margins could shrink and you're not being disciplined with your cash flow. So these are all the kind of things that could prevent a company from from having the proper things in place to have operational growth. Operational infrastructure may not be built for scale as well, so they might not have all the pieces in place that they need to really grow. So those are all reasons why companies may not have have all the components needed to properly grow.
Yeah, I'm friends with a lot of business owners, and I know we always talk about revenue, but you always talk about margins and EBITDA. So why do you think so many entrepreneurs celebrate sales or revenue while their bank accounts tell a different story?
Well, revenue is obviously important because if you don't have revenue, you really don't have anything. You have to bring money in the door. And so that's a very important piece of the puzzle, but that's only one piece of the puzzle. It doesn't tell the whole story. So if you're selling products or services and it's costing too much to provide those products or services and you don't have good margins, then even if you're growing, you still not don't necessarily have a healthy company. You really have to be able to keep your costs under control and make sure your fixed costs and overhead aren't out of control. Many companies have actually grown, and then what happens is their costs get too high and their revenue may go down, or they overhire people, and it could prevent you from having the bottom line that you need. So often when people hire us to provide CFO services, their top line looks good and their bottom line isn't looking so good. And we really have to kind of dig in and understand, are their employees being efficient with their time? Are they spending too much to provide their products that they're selling? So these are all things that we can look at to help companies. But yeah, that's a big problem. They look at revenue and they don't really look at their EBITDA margins until they realize there's a problem.
Well, there is this theory as well that you kind of reach plateau, like in terms of growth of profitability, I guess, at kind of 1 million. It's very difficult to get past that kind of landmark. And then again, I think it's 10 million. So when a company grows from this 1 million to 3 million in revenue, so let's be a little bit more specific. What
Hmm.
financial stakes typically destroy profitability during that stage of growth? You kind of
Yeah.
mentioned already not being aware of the fixed cost, not managing costs effectively. Is there anything else that really affects the bottom line?
Yeah, I've seen this happen with a lot of companies: overhiring, overcommitting, getting yourself in too much debt. These are all things that these are all different things that could prevent you from having the type of profitability that you need as your company grows. I mean, we've seen companies that are Fortune 500, companies that have billions of sales, that go bankrupt because they can't keep up with their fixed costs, and they can't. And what happens is they overcommit themselves. They end up having too much debt. And then obviously you have interest on debt. So you have to pay the principal and the interest back. And then you end up getting yourself in a bad situation when you don't have enough cash flow to cover your debt plus all your normal operational expenses. As I mentioned before, tracking employees' efficiency, looking at the bigger picture, these are all items that can destroy profitability. Having too much fixed costs and overhead. I've seen clients get themselves in situations where they commit to very high rents, or they're building properties, and they're all under the assumption that their revenue is going to continue to grow. And what happens is, if you don't hit those numbers that you think you're going to have, and you still have too much fixed costs, too many employees, too much overhead, then that could destroy your profitability.
Yeah, makes sense. I can see that. I think also many founders, when they are looking to grow and scale, they start looking into attracting investors to raise that capital. But few of them really understand dilution governance and the pressures that come from that outside capital. What harsh realities hit founders once outside money enters the picture?
Good question on it. So when you don't have outside money, people with their own company, they can run a lot of them run personal expenses to the company generally for tax savings. When you have outside investors, you can't do that. There's much more accountability. You have to have great accounting. You have to have your numbers up to date. You have to be able to provide financials to outside investors because they want to see how the company's doing and understand how the money that they've given you to invest is being properly spent. So a lot of it has to do with accountability. And also, sometimes when you have outside investors, they want to get involved with managerial decisions. So you have outside pressure of investors wanting to make sure that their investment is going well and how's their money being spent. So you have that pressure as well. And then when you have dilution means that as you bring in outside money, you're issuing more shares, and now you're diluting your ownership in the company. So you have to be careful on that, because when there's cash flow or potential or distributions, or when there's a potential sale in the company, you get less of that because now you have outside investors. And then sometimes I've seen in the past companies get tripped up is because they provide convertible notes, which is a great way to bring in outside money that converts to equity with being able to essentially push your valuation down the road a little bit where it could potentially be higher. But what happens is often convertible notes convert on a Series A, for example. So what happens is you're raising money on a Series A. So you're diluting your company, and then you also have to convert all the convertible notes to equity, and it's like a double whammy. And I've seen companies get way more diluted than they realized they were going to be. So you have to be very careful in raising just enough money to get to a milestone where then you can increase your valuation and raise money at a higher value. So it's very much like a balancing act. You don't want to you don't want to raise more money than you need to and over dilute yourself, but you want to be able to raise enough to get to a certain milestone.
So it sounds like you really need, to consider longer term strategy because sometimes these short term gains come back and bite you, in a couple of years' time when you are looking to scale.
Yeah, I've seen it many times.
I know that a lot of people get you in when they start preparing financial models for investors. When you review startups numbers, what rookie mistakes do you see over and over again?
The one thing I see probably the most, and I see a lot, is companies overestimating what their growth is going to be. So
Mm.
it's pretty easy to put a financial model together and say, yeah, we're going to grow 5% every month. But actually making that happen is much more difficult. So you see companies with these hockey stick growths where, in year one, we're going to have 10 million. In year two, we'll have 50 million. In year three, we'll have like 150 million. And they go out and try to raise money on those numbers. And investors are usually much more savvy and realize that that's not very realistic. And getting to a point of really high growth and getting that type of revenue is very
Mm,
difficult. So what happens is you may project in the future that, hey, I'm going to have this type of revenue growth, and then those dates go from to projected to actual as time passes, and then they usually have to push that growth forward, or they have
mm.
to correct it. So overestimating growth is something I see all the time. It's a lot easier said than done.
And you work with high growth company across many sectors, so you probably see it on a daily basis. What financial disasters tend to appear when founders chase growth without financial discipline or a proper financial strategy?
Great question, Anna. Thank you. The thing I've probably seen, the one problem that I've seen the most of is companies going out and raising money and spending it too quickly without really understanding how, basically having the financial discipline to know when to spend it, how to spend it. Companies get maybe $1 million raise and they think that's plenty of money, which, I mean,
Mm,
it is a lot of money, but I've seen companies burn through that money way too quickly and then have to come back to investors and ask for more. And it
mm,
puts them in a much weaker position valuation wise. The key thing is to understand when you raise money, what your use of proceeds are, how you're going to use that money to hit milestones. Milestones it could be a lot of different things depending on what stage your company is in. It can be generating revenue for the first time. It could be having your IP get licensed. It could be no longer being in the black. It can be getting new customers or different revenue streams. The point is, you need to be able to take that money and determine what those milestones are and make sure that you can achieve those milestones with that money. And then if you need to raise money on another round of funding, you can raise your money at a higher valuation because you can show the accomplishments and milestones that you've hit. But yeah, the biggest problem I've seen is companies burn through their money too fast and haven't really accomplished anything. They overspend, they hire too many people, they get a big office with high rents, they have too much fixed costs, and then they spend too much on marketing and advertising without getting a good rate of return, for example. And then they're out of money, and then they're in a bad position. The investors can come back and actually have a what's known as a down round when you have to raise money at a lower valuation. And that's not a
mm.
good trajectory that you want to show.
Absolutely. So, speaking of milestones, it strikes me that many business owners just check revenue monthly, and that's what I do as well. I look at my revenue. Does it meet the expectations? We have projections for this year. As long as it meets it, there are no huge discrepancies. We feel happy and accomplished. But if one wants strong financial control, what numbers should a business owner be reviewing weekly, maybe?
Well, I mean, it depends on the type of company and how profitable you are. If you're a pre-revenue startup or you're a startup that's still operating in the red, then you're relying on outside investors to fund your company, then cash flow is the most important thing. So when we do financial models, sometimes companies have models that are just a profit and loss statement. Ours is a balance sheet of profit and loss and a cash flow because cash is the most important thing. Once you're out of cash, you're in a very poor position where you can't pay salaries, you can't operate your company, and you're at a poor position to negotiate to get more money in the door. For companies that are operating in a profitable position, look, you have to look at what your KPIs are, your key performance indicators. The biggest ones are generally profit margin and operating margin. You want to make sure that your company, as you grow, is still profitable, that your profit margin and operating margins are not dwindling as your company grows. You want those to hopefully be consistent, or even as you grow, hopefully get even stronger. And then there's other KPIs like your current ratio. If your current liabilities are, which means what's due within a year, is higher than your current assets, then you may not have the ability to pay off debts and those types of things. So you want to make sure that you can look ahead and foresee those types of issues beforehand. And those are all, not just looking at revenue.
It's actually interesting you mentioned operating margin versus profit margin because someone asked me the question. They didn't know what the difference was. Can you
Yeah.
explain to us what's the difference between profit
So
margin and operating margin?
yeah, profit margin or gross margin is your sales less your cost of sales. And that could, even if you're a service provider, it can be services less your cost of services. So how do you determine what your costs of services or sales are? That's really what goes into generating your sales. So
Mhm.
for example, if you're selling like computers, I'm just saying that because I'm in front of one, and it costs you $500 to make one, then if you're gonna sell 100 of them, that's $50,000. If I did my math right there. That's a direct cost that goes into providing a service. Then, and that's what's called your profit margin or gross margin. So you want to have a good margin on that. Generally, it depends what industry you're in, but if you can have like a 50 margin in most cases, you're in good shape. Then after that, you have what are called your general and administrative expenses. That can be marketing, that could be rent, insurance, all these types of things that you need, but they don't go up with your sales. They don't, I mean, they could, because you would still have to have more administrative support and those types of things and insurance as your company grows, but it doesn't correlate exactly, right? So once your operating margin, or that's really even your net income, is what your income is after your general and administrative and marketing and sales expenses. So that's the difference. Those expenses that are considered not the cost of sales don't necessarily grow at the same correlation as your sales.
Okay, so more fixed costs rather than variable costs. So basically,
Yeah, exactly. I mean, at some
Mhm.
point you may have those numbers go up as you grow if you hit certain
Mm,
capacities, like for example, rent. If you get too big, you may have to rent a bigger space or get more insurance or do more marketing, but it generally doesn't correlate the same way.
great. Something else. Many business owners say that they hope to sell their business one day. I think that's the dream. Everyone wants to build and sell. From your experience, however, how many companies actually become sellable versus just trapping owners inside the very business they owners inside the very business they built and it becoming their job for life, basically, where they become self-employed?
So great question. Also, I love your questions, Anna. So, I think what business owners need to ask themselves is, God forbid, if I drop dead tomorrow or I can no longer work, can your company be maintained without you? Right. So, if you are the company, then you can't really sell it. If your company could kind of run on its own and you have all the components in place, then that makes it much more sellable. If you are the company, if you're doing all the work for it, and that makes it much more difficult to sell because it all relies on you. So if you want to make your business sellable, you need to be able to have essentially making it so it could run without you, or at least have it so the person that you would sell it to or the company sell it to has someone that could step into the role that you have fairly easily without too much attrition from your current customers or clients. So that's
Yeah.
something that every company should have an exit strategy and have something contingency plan if something happens to you. So your company has value. You don't want to be in a position where something happens to yourself that your family or state doesn't have the ability to sell it for, have enterprise value that you can sell it for.
And if I may add, I think a good accountant, good CPA firm and support years before you start thinking about selling is crucial because I have some experience in selling businesses. And if I learned one thing is that potential buyers are looking for very clean financials. If something looks unclear,
Yeah, you obviously want to have your legal in order, you want to have your accounting in order, you want to have your taxes in order. This is all like part of like due diligence. So you want to make sure that, what's the saying, that you have your house in order. If your books are a mess and you're behind on your taxes and you have legal problems, that's going to make your company not nearly as, something as
I think not just that, but an experienced CPA who actually worked with exits like yourself, they will be able to devise a strategy for numbers to tell a certain story. Because once you file those taxes, it's too late. Your books are closed. So if you start thinking about it, 2, 3, 4 years in advance and you want to build a certain narrative, it needs to be supported by numbers. So it's very important to get someone who is experienced in exits and knows how to build that narrative because what you say, if investors goes in, goes out, they're looking at numbers and whether it's supported by, how the numbers are presented. So definitely, I would definitely highly recommend.
Absolutely. Yeah. We work with companies often who come to us and say, hey, I want to sell my company in 3 years or 5 years for this price. And how do I do that? So we look at EBITDA. That's very important because most companies are sold based on a multiple of EBITDA, depending on what industry they're in. So we can kind of back into that. And the higher your EBITDA is, generally the higher the multiple as well. That's why private equity loves to come in and buy up companies. I get calls now, people wanting to private equity wanting to buy into my firm. I've seen AC companies are going, they understand that the more volume you have, the higher your multiples are. But yeah, going back to that, that's very important that you want to have a good, healthy amount of net income and EBITDA because that's really the determining factor on what multiple you'll have and how much you can sell your company for. So it's not
Yeah.
just the top line. It's really the most important thing is the cash you're generating.
Absolutely. And things like diversifying your risks, obviously, as well. Heard a friend of mine works with Exit Management Institute, and she always says diversify risks. If you have one big client, you're not worth as much as when you have 10 smaller clients who brings the same
Yeah,
amount.
absolutely. There's customer risk, there's supplier risk. I feel like I'm doing audit work here when I say that, but you're absolutely correct. If you have one customer that's 50% of your business and someone wants to buy your business and you lose that customer, you've just lost half your revenue. That creates risk and potential buyers, investors look at that. So you want to diversify your customer base, your supplier base. If you're buying all your product that you're reselling from one customer, in say another country and then they're no longer able to sell to you for either like legal reasons or they go out of business and you can't get the product that you need, then that's also risk. So diversification is very important for supply customers and other.
Yeah. Well, final question for you. I'll be happy to hear. Most business owners listening to this episode today probably think, well, my finances are fine. They look great. I just want to hear how I can, save some taxes or what can I do to diversify what I do. What are the three warning signs that indicate that a company is actually heading toward trouble, even while revenue grows?
Three things. All right. So I would say one of them would be cash flow isn't keeping up with your revenue. So
Hmm.
cash flow, or you can even say your bottom line, your operating margin, your EBITDA isn't keeping up with your revenue. So that means as your company grows, say if your company grows 5 times, but your bottom line isn't growing, then that could be a problem. Can mean, some indicators that can indicate there's an issue is that clients are taking longer to pay you. That means your accounts receivable number is growing, and there's a good chance you're not going to collect on all of that. You're, under GAAP and accrual method of accounting, you're showing that as revenue. But if you haven't collected that money and that number keeps getting bigger, then that can be a problem. Sometimes covering your costs and your payroll feels tight despite higher sales, that could be an issue. So yeah, when revenue growth without cash flow growth usually means margins are eroding or your prices are off, then that can be an issue. Another thing is your gross margins, which we were just talking about before, are quietly shrinking. So if your costs of labor and materials are rising faster than your pricing, in other words, the cost that it takes to provide your product is going higher than you can increase your prices, then that can be a problem. Or if
Mm.
you're providing discounts or concessions, those types of things, a shrinking margin, like I said, could definitely be a problem. And then a third one could be, I guess, what you would call operational stress is increasing faster than headcounts or like systems. So, like, for example, when your growth outpaces your infrastructure, then that can cause problems. So perhaps
Mm.
the owners or the key staff are working unsustainable hours. You're not able to keep up with your growth. You're having mistakes. There's mistakes in what you're providing. There's customers are complaining. In other words, the quality of the product or service you're providing is starting to diminish a little bit. Then
Mhm.
that can be a problem. And perhaps you're having turnover of your staff is starting to go up. So I would say it's operational strain because
Mhm.
when you grow and your revenue goes up, that's a good thing, but there could be cracks in the pavement because you're not of what we call operational stress. So that would probably be the third one.
Okay, great. Well, that's it. You'll be happy to hear for today.
I hope my
Good.
answers weren't too boring and
Abs-
people will be able to
I'm sure. I'm sure. I'm not asleep yet, so
enjoy.
we're all good, I think. And I'm not someone who usually is very excited to hear about taxation and accounting, things like that. It was actually very interesting, and I took some notes to follow up on,
Yeah.
to debate with my AI, to talk to Claude about tonight. But I also know, many people perceive accountants as a little bit dry and not
Yeah,
interested.
we get a lot of crap from people. I was
Yeah,
thinking of starting like a support group for accountants because we're always
great
considered like
idea.
nerds and made
Absolutely.
fun of.
Yeah.
It's
But I know that you actually have some, skeletons in your closet because I know you personally. And you are, fun person to be around with great sense of humor, with very diverse range of interests. And actually, I was going to ask you a personal question. I know you're
Sure.
very proud of your daughters. You're very much a family man, very committed to your family. Would you mind, and they are very talented, would you mind just giving us a little bit of insight into what your daughters do and how you support them?
Awesome. Sure. Yeah, I love showing them off. So, I have two daughters, Maya and Lucy. There's 19 and 17. Maya is studying to be an opera singer, and she's at Oberlin College in Oberlin, Ohio, and she just had her first major opera part that we just went up there to go see, and she is no doubt going to be a famous opera singer. She's killing it. And we're all very excited about what she's done so far. And I'm sure she'll be performing at the Met one day, and you'll be able to go see her. And I wasn't the biggest opera person at first, but now I've been to like 10 of them, and I really enjoy it. I think it's a great art, and we're excited about her. And then Lucy, my younger one, she's 17. She's a senior in high school right now. She just got a full ride to Berklee College of Music for singer songwriting, which a full ride, it's like less than like 0.1% of people get. So we're very excited about that because that's going to save us a ton of money, but also because it just shows that they recognize her gifts and her art. She actually had to go there and do a performance, an audition to get in. And I said, how did it go? And she goes, I don't know. I blacked out, but I went on my knees when I was singing. And she did a Led Zeppelin song. And then she sang one of her own original songs. And she's got probably like, she already has like a catalog of original music. She's got probably like 30 original songs. And my wife and I are like singing them all the time. I mean, I know there's a lot of people out there trying to do this, but I think we have something special here. She definitely has a gift of writing catchy songs. So I could play some for you, Anna, when you have a moment. And, you know, uh, she already is starting to get her what's something called her TikTok and her Instagram going to try to get people to follow her. And you could see her putting on some originals and a lot of cover songs on there. So she's starting Berkeley in the fall, and we're very excited about that too. And hopefully we think there's a very good chance that, you'll be seeing her at sold out arenas soon.
Oh, wow.
So
So how
we're,
are you blessed with two such talented daughters? Are you a closet musician yourself, or where does that gene come from? Or is it your wife who is
oh,
more musician or artist?
well, my wife was a singer when she was in her younger days, so they definitely got the singing from her. My singing isn't great. I'm much more of a karaoke rapper. If you ever one day will hopefully be able to see me do that. I am a musician myself. I play a little guitar. I'm much more of a bass guitar player. I used to play in a few bands back in the day. In fact, a drummer that was in a band of mine is now the drummer of the band Live. If you've ever heard of the band Live, they sing like I Alone and a few other big hits. He plays with them. So, and I got to do accounting. So I guess he won that one. But my wife's brother, who unfortunately passed away at a young age, was a very what's the word I'm looking for? Successful reggae artist. So this is like just like a regular like guy from like Palm Beach Gardens, and he knows all these reggae artists all over like Jamaica, and he's performed with. I could probably go on like Apple Music or Spotify and bring up hundreds of songs that he produced. He's worked with the Marleys, and he toured with Shaggy. He's played with
Oh,
Sting. He definitely we have music in our family. So
look at
I
that.
think a little bit from both sides, probably more from my wife's side.
Love it. Well, Jason, thanks so much for your time. It's first time ever I'm interviewing an accountant and, tax professional with his own company who has music in his blood and in his life. This is super exciting. So it was a great insight into your more personal side of you. Thanks so much for your time and for joining us during in the middle of your tax season.
Anna, you're awesome. Thank you so much for having me and sharing this with me. And I really appreciate it so much and all the great things that you do. So thank you so much. And yeah, I appreciate it. I look forward to seeing you soon.